Hello and welcome back. Hope you're good, doing well. So this is US 10 year yield. Hopefully you have seen the previous analysis on it. Okay, if haven't, then let's look at the previous video analysis and then we're gonna talk about the update.
Hello and welcome back. I'm looking at the US 10 year yield. So US 10 year yield is pushing higher after breaking out that weekly correction and heading back to that 180 mark. Okay, so we are at 161. Okay, we are still having a couple of more more room for upside, and we may see drop on the US 10 year yield from that previous top, and it can visit that previous low again. Let's look at the previous charts first, and then we're going to talk about the updated chart. Okay, so when it was setting up for a breakout weekly correction, all right, and we got a breakout and it's on its way. As we know that Fed is preparing for the tapering in November, okay, which is causing the strength on the US 10 year yield. Okay, and also we know that inflation is above 5%, all right, and there are fears that we may see stagflation, which is causing the yield to push more higher. Okay, so heading back to 180 marks. Okay, and there we can see it's heading back to the previous top. And now let's look at the weekly updated chart. All right, so last week stronger numbers on the US 10 year yield. Okay, and we still can see some more upside on the 10 year yield back to 180, and then we may see a drop over there from that top and back to that low. If I'm going to look at the lower time frame, price is still strong. I mean, the US 10 year yield is still strong. Okay, any correction will push this for more upside. Okay, so which means that dollar still can stay strong for a couple of more days. Okay, days to week. Okay, so any correction or deeper pullback, okay, will push US 10 year yield for more upside. Okay, continuation also can happen rather than this one more drop. All right, so it is still strong and we still got some more upside room. All right, so which means that gold is still hasn't finished its bearish move. Okay, and gold can drop up to 1680. Right, so right now it's being traded at 1750, yeah, somewhere there close to those numbers. Okay, and we still may see more pressure on the gold all the way up to 1700 or 1680. Okay, and we may see buy opportunity over there on gold at 1680, around 1680. Okay, so you're watching yield to hold that previous top and drop for another leg lower all the way back to that low. All right, so hopefully you got the idea. So thank you very much. We'll see you back again in another setup. Until then, bye bye.
All right, so that was the US 10 year yield previous video analysis. Now let's look at the update. Okay, so we were expecting it to correct and then continue. So we have seen correction on lower time for our time frame, and then it pushed higher. Okay, and then started to drop. Okay, it didn't hit that 180 mark or this previous top 177. Okay, and then start dipping over there. All right, and then we were expecting this to continue to keep dragging lower, give us that flat formation and drag lower. We have seen that flat formation and then price went lower from the previous top. Okay, then we were expecting it to break down, continue to keep dragging lower, or go back within that flat formation for another leg higher. So it dropped aggressively. All right, came up to 145. All right, and that's the flat formation as well, so should be there. Okay, so dropped, that flat formation went lower. Okay, and then we have seen higher inflation numbers. So when I was analyzing that previous video analysis, at that time the inflation was around 5.80, I think. All right, and the numbers which broke out last week is around 6.20 on inflation. Okay, which was causing inflation to push up, because the push up which we have seen over there on the yield, US 10 year yield, was driven by the higher inflation. All right, and we also know that in the November, Fed has announced that they are tapering. All right, so they have started tapering this month, and they have announced that in the previous FOMC meeting. So which is a good sign for the yield to go higher for longer term. Okay, because Fed still not showing any concerned that the inflation is not transitory. All right, that's the reason yield is not jumping very aggressively. Okay, as long as Fed is sticking to their idea that the inflation is transitory and inflation gonna drop rather than the rates gonna go higher, okay, we may see pressure on the yields. Okay, so yields may stay, you know, sideways or can drop, okay, the way I'm showing. All right, if Fed is going to say that they are going to fight with inflation, all right, and they are going to wind up their QE program before the timeline they have announced, all right, so they have announced that they're going to end up, you know, within 6 months, all right, which is going to be somewhere around, you know, June or July next year, okay, 2022. I'm not sure the exact date, maybe you know that, all right, but it's a 6 month, you know, time period. You know, within that 6 month time period, they're gonna end that QE program. All right. So if that timeline is going to change, all right, let's say Fed is going to say that we're gonna end up within 3 months or 2 months. Okay, that's gonna be a very hawkish sign for the yield. All right. And that can drive the yield very aggressively for more upside. Okay, that means they are showing you know, concerns, and inflation is not going to be transitory then. All right, and that means that they are going to fight with inflation. They are going to end their QE program as soon as possible, and right after that, if they say that, right after that they start talking about raising rates. Right now they are saying that they're not going to raise the interest rate after ending QE, all right, which is not a, you know, very, you know, bullish sign for the US 10 year yield. Okay, if that, you know, theme is going to change, all right, right now they are saying that the inflation is transitory, yield is not pushing aggressively higher. Okay, if that theme is going to change, the QE, you know, timeline is going to change, and the Fed tone is going to change. All right, and they are going to say that the risk is there for more upside on the inflation. All right, and they are going to wind up their QE program and going to tighten their policy quicker than expected. Okay, that's going to be a very you know, strong bullish sign for the US 10 year yield, or the other yields as well, and a very stronger bullish sign for the dollar. Okay, dollar can keep rising very aggressively for upside. All right, so if they are not going to show any concerns, all right, and still going to stick to their transitory theme, all right, and going to end their QE program within the timeline, then we can see another drop on the US 10 year yields back to that 120, the way I'm showing right now. All right, and right after that we may see, when they're going to end QE program, right after that we may see, you know, strength on the yield for longer term, for more upside. So all this means that we still may see another leg lower on the US 10 year yield. It can visit that previous low. If not that previous low, then at least it can visit that 130. All right, 130, 135. It has already visited almost 145. All right, 1.45 or 1.43, these areas. Okay, so which means that 130 or 135 is not far away. Hopefully you understand that. So what we are simply looking another leg lower on the US 10 year yield and complete that pattern formation. Okay, and then start rising over there for longer term for upside. All right, so the theme or the fundamental analysis which I have made over there, okay, if that is going to happen, we may see sharp rise on the yield. Okay, yield can continue to keep rising over there from current 1.60 or 1.56 within these areas. Right now I'm not anticipating this move. Okay, this is not making sense for me. Yeah, and another leg lower is making more sense for me. All right, and another thing, the higher the rate goes aggressively, the bigger the problem going to be for the Fed to manage that. Okay, they will not let the rates to go higher aggressively. All right, so hopefully you understand that. Now let's look at the lower time frame. So for our time frame, okay, so for our time frame, we are having a sharp pullback, very much similar like the dollar yen chart. Okay, if you have seen the dollar yen chart analysis. Okay, so this 4-hour time frame correction to break down, okay, and resume its bearish trend all the way back to that previous low, or as I said, 130. 130 or 135 within these areas. Okay, if it keeps pushing slowly higher back to that 170 area, okay, so still it to drag lower. It's not going to change the bigger image if it tests that previous top. Okay, so hopefully that makes sense for you. All right, and yield to stay sideways rather than a spike, another spike up for more upside. All right, and test the previous bottom, or at least 130, and then start rising for longer term for upside. All right, so thank you. We'll see you back again in another analysis. Until then, bye. Okay, so keep in your mind that the yield is very important for the rest of the market. Thank you and bye.